Daily programming do not necessarily reflect the views of the management or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
5 things that you need to know about investing. Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Got a question for me? Please go to the website at prudentmoney.com. Send it in and I will get that question answered for you. That's off the website, www.prudentmoney.com. Well, last Thursday I interviewed Greg Johnson. Greg, the whole thing behind the interview was to talk about cryptocurrencies, what's going on. And literally, one of the biggest financial stories is occurring right now. It happens to be in cryptocurrencies, and it's really unfolding without just a whole lot of media attention to where just anybody would read it and go, wow, that's going on. You kind of have to go look for the story. I mean, if you go, for instance, if you go to CNBC, you're probably going to see an article about the story that's happening. But the question was, and this was something that Greg brought up, is that cryptocurrencies have lost an enormous amount of money. There's a lot of negativity going on right now, and we'll talk a little bit about that again. But the question comes down to, is crypto a legitimate place to invest money? And knowing what we know now, is crypto a place that should be considered in asset allocation models? In other words, should we consider cryptocurrency as an investment in our portfolios? Before I go any further on that, 'cause the one thing he said makes a great point, is that if you were going to put cryptocurrencies as a part of your overall portfolio, I got to tell you that I would make sure that it was a very, very small percentage, because this is about as risky of a move as you can take, in my opinion. Now, the question, I want to answer the question, and I brought this up and kind of highlighted this from a point that Greg was making. Is cryptocurrencies, given everything we know today, a place that you would want to put your money? Is it legitimate? Is it someplace that has long-term value to it? Greg described it as an investment that is a long term. In other words, said another way, if you're going to buy it, you want to be in it for a very, very long time and not touch it, because it is not only is it very extremely volatile, as we have witnessed with Bitcoin, it can take a big loss. And the big loss and I haven't looked at it today or checked where it closed on Friday. The last time, let's just say the last time I looked at it, which was Thursday, Bitcoin from a year earlier had lost roughly 75% of its value. Now, there were people and investors putting tons upon tons of assets towards cryptocurrency, and on paper, they looked pretty wealthy. But like I said, 75% down is a huge drop in value. I mean, probably the worst that I've seen on an accepted market, it was 1929 to 1932, which we talked about, which the Dow Jones Industrial Average dropped negative 86%. So once again, the question is it a legitimate place to put money? What has happened to cryptocurrency over the past month or so, and in decline over the past year, is nothing more than what happens to investments who get into a bubble, an investment bubble. So what's the opportunity that you have is to watch in real time an investment go through the phases of a bubble, and that bubble pop, and the value drops dramatically. And that's what you are seeing. It is no different than the French tulip bubble, stock market bubble of the 20s, stock market bubble of leading into the financial crisis. Today, will we see it in the bond bubble? What will come out of the bond markets that will shock us that's coming out of the crypto markets? Probably not the same thing, but I'm sure there will be something that happens, because that's what happens with investment bubbles. You know, an investment bubble is defined as a period of time where an investment is considered can't lose, it's going to make me rich, I want to put all my money towards it because it's going to grow exponentially, and it's the next big thing. Back when before the real estate crash in 2008, you had everybody flipping houses because real estate was going to make you rich. I mean, you had a bubble there, and that bubble popped, and of course looked horrible as it lost money in the real estate markets. And then we learn that all these toxic loans were backing these mortgages, which just sent the real estate markets crashing even more. So you got to watch it in 07 and 08 with the real estate markets. And last year we were talking about this. This is when I believe the words that I used were, this is an unsustainable investment, in my opinion. And of course it topped and started to come down from a year ago, roughly in November, I think was when it hit its high. And generally what happens is there's some fraud that's uncovered. And once that fraud is uncovered, there's missing money, and there's all kinds, and then of course there's a dramatic drop in the value of the investment in question. If you read any of the history books of what happened between 1920 and 1929, that was the roaring 20s, and there was all kinds of people stealing money. There was a lot of fraud going on, and of course it led to the greatest stock market crash in the history of the markets. And the other thing too, excuse me, is when you're looking at what happened in the 20s, you were also looking at pretty much an unregulated marketplace, which is really what we were seeing in the 1920s. The SEC, who regulates the markets, I don't think that they were first organized and started into a governmental agency until 1932, because they saw what an unregulated market would do. Well, the crypto market was without question unregulated. But the ongoing stories that are coming out is probably the main one is Sam Bankman-Fried. He was a high flyer in the world of crypto, built up a personal fortune. I've seen $16 billion as just almost overnight, or it was either 16 or 32 billion. And then everything went wrong, potential fraud accusations, there's missing cash, borrowing, there was a lot of borrowing to leverage the bets on cryptocurrency, and everything came tumbling down. And you look at a situation like that and you go, why would I want to invest in that market, assuming, and I would assume, that crypto is not going to go anyplace, that it's still going to be sticking around. Granted, it's going to be a situation that's highly regulated, so we really don't know what that will look like. But regulation in that particular market works. In fact, if you look back in the 20s, one of the biggest things that the SEC did was prevent people from taking their assets, which mostly back then was family farms, and borrowing up to 100 to 105 to 110% of that family farm and taking that money and investing it into the stock market. That's what a lot of people were doing. So when the market dropped, they would the brokerage houses would sell stock into this declining market so that they would have money to pay back the money they borrowed. And of course, you didn't have 24-hour news cycle. You didn't have. I mean, literally, they had to find out what happened in the market the next day as the newspapers came out. So totally different situation, but it was a regulation issue back then, regulation issue right now. I mean, there was another story that Greg talked about where billions of dollars of crypto was stolen through a hack, and the money was discovered, I think, some 4 years later, something like that. And the people were, the investors were relieved that they uncovered the money, but they didn't all get paid back, and that's still all tied up in the court systems. If you'll remember, Lehman Brothers, which was the biggest financial bank or financial brokerage company in the world, went under in less than 24 hours of them really crying for help, if you will. The government decided not to save it, and Lehman Brothers goes down bankrupt no more. And of course, that almost brought the entire financial market down. So it's one of those things where they all have the same characteristics, just different investments. Hey, this is Bob Brooks. We're up against the break. Stick around, and I'll be right back.
The Word for Today is excited to announce the new official online home for the ministry of Pastor Chuck Smith and Kay Smith, PastorChuck.org. At PastorChuck.org, you'll have instant access to thousands of hours of verse-by-verse teaching by Pastor Chuck Smith from Genesis through Revelation, and full access to special messages on subjects such as prophecy and much, much more. Also at PastorChuck.org, a full library of great teachings by Kay Smith, and a section where you can read some of Pastor Chuck's books online, all free of charge. So visit the new official online home of the Word for Today and the ministry of Pastor Chuck and Kay Smith, PastorChuck.org.
This is Rob Randall, your host and teacher of the Invisible War radio program. The Invisible War is the study of God's Word on how to walk in Christ's victory in the spiritual battles we face against the powers of darkness. Join me every Sunday morning at 9 right here on KDKR and KYJC in Commerce, your station for life.
This week, Alistair Begg concludes our study in the book of 1 Samuel by examining the tragic collapse of King Saul's dynasty. Learn why it's dangerous to rationalize sin, to obey only parts of the Bible, and to ignore the reality of God's wrath. That's on Truth for Life with Alistair Begg.
Weekdays at 5:30 a.m. here on 91.3 KDKR.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Listen, if you got a question for me, please go to the website at www.prudentmoney.com. Send that question in, and I will get that taken care of for you. That's off the website, prudentmoney.com. So to answer the question, is cybercurrency, a good place to put money? I, of course, would not touch it really at this point until kind of see how some of this plays out. But I think that cybersecurity security, cyber currency, is not going anyplace. But it's just going to be a different version of it. And once again, if you were to dabble into that or trying to buy after a 75% drop, just know it's a very, very, very risky investment at this point. And you want to be very careful with your hard-earned money that you're trying to be a good steward over. Let's talk a little bit about the 5 things that you need to know when it comes to investing. And this is taking everything that is taught from the standpoint of taking risk, of selling, of holding, of having a strategy, the things I talk about, the things that Pop Culture Finance talks about, and kind of pulling them into one place to look so that you have a list of 5 things to consider no matter what you're doing. Because once again, even though I don't agree necessarily with Pop Culture Finance, I'm the last person to be able to say, yes, I'm right and you're wrong, because only time will tell who was right or who was wrong. It's just an opinion. So the first one is, whatever you do over the long term becomes a habit. And that is, if you invest with the mindset of the markets go in cycles, and you have good cycles and bad cycles, and you have an investment strategy for each, and you do that and you practice that and you make decisions based on that, and that frames everything that you do with investments, you will take that into retirement. Of course, nothing is perfect. I do think that gives you the opportunity, in my bias, to invest in all different kinds of markets when there's not just one market that goes up. But it becomes a habit, and this is my biggest issue with Pop Culture Finance that says, well, you're an investor for long term. You don't sell, you don't change anything, you just ride those losses out and the market will come back. That becomes your habit. And you take that, once again, you take that habit into retirement because it's always worked for you on some scale. And that's a dangerous mindset to have in retirement when you really need the money. Number 2, selling investments. There's 2 ways to sell investments: out of emotion or changing your risk level. And what Pop Culture Finance will tell you is that you can't time the market. You can't try to pick a top. You can't try to pick a bottom and reinvest. And I don't disagree with that. The possibilities of you picking the right entry spot or picking the right time to get out are very, very slim. And a lot of that is driven by emotion, either the emotion of fear or the emotion of greed. Think of it this way: if you're going to sell investments, do it because you want to change your risk level, and that's a totally different conversation. So today, if you go to your advisor and you say, I really want to sell some and change things, and the advisor says, no, you don't want to change things, you're a long-term investor, if you had got a little bit deeper into that conversation, probably what the advisor would hear is, I want to change my risk level. And like I said, that's a totally different conversation. Number 3, does it make sense to stay in a position that there is a high probability that a lot of money will be lost? I mean, it's a fair question, and it comes down to, and it speaks to whether or not does it make sense to change your investment strategy up. Not to time the market, but does it make sense to change the strategy, because what you were doing probably is not going to work too well in the given months ahead. And you got to evaluate just about every position in your portfolio, because what you're looking for, let's just say that you stayed in an investment and it went up over time, then it came crashing down and is about to recover, and you got to ask yourself, is this particular investment, now that it's crashed, is it the right investment to be in on the way back up? Because they're not always what you went down with makes sense to go back up with. And And the thing is, you can look at that and go, well, but if you sell it, you've realized your losses. If it's lost, it's gone, whether it's on paper or not. That's what I'm trying. That is a paradigm I'm trying to shift. Is that you don't even think about paper losses. Think about it from the standpoint of it comes down to, do I want to try to recover with this investment, or is my money best suited invested in something else that would recover better? Number 3, human nature is to come up with a theory that eliminates risk. If you do these things, it's almost risk-free. And I wrote a piece on this last week, and it's at the Prudent Money website. You can go check it out. Is that it's human nature to want to do everything we possibly can to figure out how to eliminate risk, and to eliminate it completely to where if you invest, you'll be okay. You can't eliminate risk, and it doesn't matter what the latest mousetrap is. You cannot eliminate risk. It's just almost impossible to do that. And if you listen to Pop Culture Finance, it's almost as if, well, as long as you stay invested and stay in for the long term, the market will come back and you'll get back your losses. Well, if you really kind of read between the lines, what are they saying? They're saying that it's a risk-free investment because you've just eliminated the risk because you stayed invested. As I've always said, investing for the long term is not a great way to manage for risk. Because once again, I go back to what I said a second ago. Why would you want to continue staying in an investment that has the possibility of losing a lot of money? Why wouldn't you want to switch it to something that's a little bit lower risk? Now, granted, someone in Pop Culture Finance would argue, well, but you're changing and you're trying to time the market. But you're making a change. You're shifting, and I would say back to that, you're shifting your risk level. Then number 5, the one thing to definitely keep in mind is that it all comes down to the cycle. And if there's one thing that you take away from today's program, it's this. And we talk about it all the time, and I'll continue to talk about it because I believe it's at the foundation of how investing works, is that investments go in a cycle. And that cycle goes up, that cycle goes down, then it recovers, it goes back up, it goes back down. Everything runs in cycles. Some bigger cycles, so when they're really large cycles like we've been through, you have a tendency to not recognize it, and you kind of get lost in the cycle. The emotions get spread out and get even bigger, and the greed gets bigger, and then the selling gets bigger on the other side. But if you look at the market from the standpoint of cycles that we go through, bear market cycles, followed by bull market cycles, followed by bear market cycles over a period of time, you start to see the market a little bit differently than you would if you just think, well, it's just going up over time, it'll always be okay. Not quite the truth when you really look at it. So there's 5 things to consider. I think probably the 2 biggest ones out of that is the fact that everything cycles, and what you do today becomes a habit of how you invest going forward. Because you do something over time, and you do it enough, and you repeat it, and you do it enough, and you repeat it, it becomes very instilled in you. And I've had lots of conversations with. It's just really kind of interesting with investors who, even in the midst of a big financial bear market or anything like that that's going on, will come back and say, I want to invest my money to where we're in stock, but we're focusing on dividends. I mean, it always kind of comes back to I just want to go back to doing what I've always done. If they made a change, they're just anxious to get back to what they've always done. It's a very strong habit. One that, and there's a lot of studies that show this, that create an enormous amount of loss if you're taking money out. And I would say that when it comes down to retirement, when you're 5 to 10 years out, you've got to start training yourself to think differently and put yourself into a mode to where you have a strategy for a market that is going up and you have a strategy for a market that's going down. It kind of makes sense, I think. And then obviously it's not as just easy as that, conceptually though it is. And like I said, I do think that it makes sense as we look at what's ahead for this market. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Listen, we do podcast these programs every day, and you can always go to wherever you like to hear your favorite podcast. Hopefully Prudent Money turns into one, but you can hear today's show and go check it out. You can also check it out at the website at prudentmoney.com. Well, if you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time until we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.